Let's take it across to Taimur Baig then and understand what he's making of this move by the Fed. Taimur, hi, good morning. Great to have you on ET Now once again. I guess pretty much along expected lines, a 50 bips hike, but quite a hawkish tone. I guess that is not something that the market was prepared for. Definitely not after the latest CPI print.
Right. Our title of our review for today is a hawkish tone, but not quite hawkish act. So the dot plots are one thing, the Fed governor's views and projections are on one thing. Those are all on the hawkish direction. They're expecting slightly higher inflation next year. Their terminal rates have been revised up somewhat. But if we just focus on Chair Powell's press conference, clearly he is trying to walk a tightrope with a bit of a dovish bias. He's telling the market, yes, you might see interest rates remain higher for longer and all that kind of stuff. But he's also at pains to say that a 25 basis points downshift in the end January, early February meeting is completely appropriate strategy. So our view is that the end game, as far as the Fed is concerned, is very much there. I really don't think they want to have terminal rate go beyond 5%. They want to hold it there for the whole year. And mind you, that would constitute a substantial rise in real interest rate in the US through the course of 2023 as inflation comes down and nominal rates remain high. But the Fed believes, it seems to me, that that is okay as far as market fundamentals, as far as economic fundamentals are concerned. Some rise in real interest rate with a slowdown in growth, some steady outcome as far as asset markets are concerned is, I think, as best and as Goldilocks a scenario one can hope for right now.
So, Taimur, what should financial markets focus on? Should they focus on the fact that interest rates have moved higher and they're unlikely to move higher, and they should not worry about hiking interest rates? They should start thinking about recession and the impact of recession in 2023?
So there are several things to consider in this context. One is, equity markets, and would companies that have large leverage will see their interest rate service costs go up substantially, or would they find their spreads going wider because of concerns about their balance sheet? That sort of issue comes to the fore at the higher part of the interest rate cycle, and I'm sure many companies in India and in the West, we will see that narrative play out through the course of 2023. So the question is balance sheet strength, ability to absorb this high interest rates, and so on. As far as the fixed income market is concerned, of course, we have a very steep inversion as far as the yield curve is concerned. They're just basically trying to force the Fed's hand into cutting rates toward the end of next year and cutting substantially in the course of 2024. I think that the Fed governors are not that far away from that reality either, which is that at the end of 2023, we probably will see substantial economic slowdown, a discernible pickup in unemployment rate, which would pave the way for interest rate cuts in 2024. Markets, being forward-looking, will try to price that in now, and therefore there will be some opportunities as far as the long duration of interest rates are concerned.
Taimur, what's the expectation now with the FOMC meet out of the way on the ECB and the BOE decisions?
They will be reluctantly hiking rates. I don't think either of those central banks are as comfortable about their real economic outlook as the US authorities are. Recession watch everywhere, but as far as the labor market, consumer confidence, business balance sheet are concerned, the Americans are in a fundamentally better position than their counterparts in Europe and the UK. Having said that, there has to be some degree of rate normalization. Communications from both officials at the ECB and BOE are very clear. They're heading toward another 50 basis points rate hike each. After that, given that we just saw the UK inflation numbers which show that they are also turning a corner, I think there will be pressure to soften forward guidance, perhaps even do some wait and see. This is particularly the case for Europe, where energy inflation has been the bugbear for the whole year. Energy inflation is turning a corner in the right direction. European households are not feeling as helpless and as alarmed as they were feeling just a few months ago as far as their energy bills were concerned. Maybe that will give the ECB some degree of comfort going into 2023, because for them, the stagflationary scenario is very stark. Likely recession in 23 and unlikely substantial decline in inflation, but maybe that latter part, the inflation scenario, just got a little better given the way oil and gas prices have evolved over the last 4 to 6 weeks.
Right, Taimur, great to have you on the show. Thank you so much for joining in with that quick take on what to make of the Fed commentary, what the Fed is likely to do next.